Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Afif bin Muhammad RAHIMI, and alongside with me, my group members is Ahmad FAKKARUDIN bin AZIZ, Muhammad HAZIQ bin SAMSUDIN, Iman Zuhair Hakim bin MOHAMED NOOR, and last but not least, Rashidan bin ROZMI. So today we're gonna present to you about Taxation 1 assignment. Assalamualaikum. So my name is Muhammad Afif bin Muhammad RAHIMI. Today I'm gonna present to you about what is voluntary disclosure. Disclosure is the process of making facts or information known to the public. Proper disclosure by corporation is the act of making its customers, investors, and any people involved in doing business with the company aware of relevant information. Voluntary disclosure is the provision of information by a company management beyond requirements such as generally accepted accounting principles and securities, and also exchange commission rules, where the information is believed to be relevant to the decision making of users of the company annual reports. A voluntary disclosure occurs when you provide a truthful, timely, and complete disclosure to CI through designated procedures. It also requires you to cooperate in determining your correct tax liability and make good faith arrangements to pay in full the tax and any applicable penalties you owe. A voluntary disclosure agreement is a contractual agreement between your company and the state in which your company comes forward voluntarily to pay its tax obligation in exchange for a state concession in the form of reduced penalties and limitation on the number of years under consideration for outstanding tax liability. Voluntary disclosure is carried out by many companies, although the extent and type of voluntary disclosure differs by geographic region, industry, and company size. The extent of voluntary disclosure is also affected by the firm's corporate governance structure and ownership structure. In particular, research has found that top executives have a significant influence on their firm's voluntary disclosures, and that managers have unique disclosure style related to their personal background, including their career path and military experience. Voluntary disclosure has also been identified as an important area in financial reporting research. There are links between firm choices to voluntarily disclose certain information and what they are required to disclose via mandatory disclosures. Voluntary disclosure benefits investors, companies, and the economy. For example, it helps investors make better capital allocation decisions and lower firms' cost of capital, the latter of which also benefits the general economy. It may also reduce conflicts of interest in widely held firms. Voluntary disclosure is also affected by shareholders' demands. For example, 60% of the companies on the S&P 100 adopted voluntary disclosure policies in response to shareholder demand for information on corporate political spending. Firms, however, balance the benefits of voluntary disclosure against the costs, which may include the cost of procuring the information to be disclosed and decrease competitive advantage. Voluntary disclosure can also include strategic information such as company characteristic and strategy, non-financial information such as socially responsible practices, and financial information such as stock price information.
For the different type of offense, fine and penalty in Malaysia. First, not filing your tax. If you earn enough to be taxed, you need to file your tax. If you fail to do so, you could be fined between 200 to 20,000, in prison, or both. You also have to make sure that you file your income tax before the deadline. Otherwise, you will deal with the penalties. For instance, a fine of 10% of increment from the tax payable starting from the 1st of January 2020 from both business and a non-business source of income on paying tax. After 30 of June for a source of business source of income, and after 30 of April for the non-business source of income. Section 112 Clause 1A take effect on the 30th of December 2015. It is a serious offence for non-submission of tax return for 2 continuous years of assessment or more. RIB would treat such non-compliance as rogue or willful default as criminal offence. Section 112, Clause 1A empower the IRB to exercise its best judgment and issue notice of additional assessment to enforce tax collection. Penalty of 300% of tax charge would be included such notice for additional assessment. In order to avoid being convicted for those offences, taxpayer has to show he has a reasonable excuse for not being able to do so. The question for reasonable excuse was considered in Chong Chin Cheong v. Public Prosecutor. The defendant has charged with 3 offences under Section 78 Clause A, reading together with Section 120 of Act, namely failing to complete return for the supermarket company. The return has related to prior years of assessment before his appointed. Although Section 112 provides that maximum fine offence is 20,000, the court is given the power to increase. The court may take consideration taxpayer interest as well public interest when imposing fine. Prior to 1st of January 2015, the maximum penalty is 20,000 only. Section 112 Clause 3 of the Act provides that where is relation of a year assessment, a person may default in furnishing a return in accordance with Section 77 Clause A or 77A Clause 1 or giving in a notice in accordance with Section 77 Clause 3. And no prosecution under Clause 1 or Clause 1A has been instituted in relation to that default. The DG must require that person to pay penalty equal to triple the amount of the tax which before set off repayment or relief under this Act. It is payable for that year, and if person pay that penalty, he shall not be liable to charge on the same fact with the offence under subsection Clause 1 or Clause 1A. The DG would be exercise the discretion power whether to prosecute the taxpayer under Section 112 Clause A or Section 112 Clause 1A, or merely require penalty to be paid under Section 112 Clause 3. The payment of the penalty will be prevent the taxpayer being prosecuted on the same offence. In practice, the DG would abate the remit the penalty depending on the regularity of offence committed.
Next, misreporting how much you earn. Claiming that you earn a lower income than you do could mean unlawfully paying less tax, but you will risk being fined 1,000 ringgit Malaysia to 10,000 ringgit Malaysia. Plus, you will also have to pay 200% of the tax amount that was uncharged. Underreporting your income is also an easy mistake to make if you are not aware of what types of income are taxable. Besides employment income, the taxable income also includes rental income, dividend and royalties. Section 113 Clause 1 of the Act provides any person who makes an incorrect return by omitting or understanding any income of which he is required by this Act to make a return on behalf of himself or another person, or give any incorrect information in relation to any matter affecting his own chargeability to tax or the chargeability to tax of any other person. The scope of incorrect return will include omitting or understating income and incorrect information affecting the chargeability of tax. It should be noted that the prosecution under section 113 merely involve monetary payment, that is fine between 1,000 ringgit Malaysia to 10,000 ringgit Malaysia, and especially penalty of double the amount of tax which had been uncharged but not imprisonment.
Next is overstating your tax relief. Filing your tax relief could save you a significant amount of tax, but you have to be careful when you declare them. You'll be slapped with a fine of 1,000 to 10,000 and 200% of tax undercharge for any incorrect information in matter affecting the tax liability of a taxpayer or any other person. You should also never overstate your tax relief just to get reduced tax charge. If you don't have the relevant document to support your claim, you could get fined 300 ringgit to 10,000 ringgit, imprisonment or both. When you declare a tax relief, make sure to have voucher, receipt or any other document that can be used as proof, and keep them for at least 7 years. Overstating your tax relief may be classified as willful evasion offence according to section 114 clause 1. Section 114 clause 1 provide that any person who willfully and with intent to evade tax omits from a return made under this act any information which should be included, makes a false statement or entry in a return made under this act, give a false answer to a question asked or request for information made in pursuance of this act, prepares or maintains or authorizes the preparation or maintenance of false books of account or other false record, falsifies or authorizes the falsification of book of account or other record, or make use or authorize the use of any fraud, art or conviction shall be guilty of an offence. You will be liable to a fine of not less than 1,000 and not more than 20,000, or to imprisonment for a term not exceed 3 years or both, and shall pay a special penalty of triple the amount of tax which has been undercharged in consequence of the offence, or which would have been undercharged if the offence had not been detected. But in order to prosecute the taxpayer of an offence under section 114, the prosecutor has to prove it is case beyond reasonable doubt that the act was done willfully and it was done with intent to evade tax. Section 114 clause 1A provide any person who assists in or advise with respect to the preparation of any return where the return result in an understatement of the liability for tax of another person shall, unless he satisfies the court that the assistance or advice was given with reasonable care, be guilty of any offence and shall on conviction be liable to a fine of not less than 2,000 ringgit and not more than 20,000 ringgit, or to imprisonment for a term not exceed 3 years or both. Section 114 clause 1A can only be invoked when there is an understatement of tax. However, The reason for such understatement appear to be irrelevant, except for implication that sufficient care was not taken. With such a heavy penalty provision, the cause and intent need to be positively and clearly established. Mere negligence of the person due to high volume of work or shortage of staff shall not be sufficient to invoke Section 114 Clause 1A. Section 114 Clause 1A is a criminal offence. The invocation of Section 114 Clause A could result in a high court trial. The burden of the proof would be on the tax authority to submit evidence that first, the assistance or advice given had resulted in an understatement of the liability for tax of the other person, and assistance or advice was without reasonable care. Section 114 Clause 1A place the decision on the judge as final and conclusive. Although the tax authority may have a reason to believe that the tax agent or the accountants had assisted in the understatement of tax in the return, resulting in a case being brought for a trial, it is the finding of the judge that is important. The accused would be acquitted in the following situation. The tax authorized fails to establish a prima facie case at the initial hearing. The accused would be dismissed as there is no case to answer. Secondly, prosecution failed to prove the fact in issue beyond reasonable doubt, or accused managed to tender evidence to show that even if there was an understatement of tax, it was not by the lack of reasonable care on his part. In the event that the judge found in favor of the tax authorized, the following penalty may be imposed on him, which is 2,000 to 20,000 or 3-year imprisonment or both.
For the conclusion, taxpayer have duties and responsibilities to the government in relation to the income taxes that have to be paid. In addition, the government takes seriously every offence committed by the taxpayer. This is because failure to inform or provide returns will slow down the cycle of the tax administration, as income tax is the main source of revenue for Malaysia, which has to pay for the maintenance of schools and hospitals, rural development and various other services. Failure to collect tax will reduce the national revenue, and the public may suffer from the setbacks of undeveloped country, which will also affect the country from many aspects. This is all from us. Thank you.